Hello, everyone. Welcome back to another Lunch and Learn webinar. I'm your host, Mayur Thaker. I am an analyst and co-portfolio manager of the Zacks Earnings Certain Portfolio, one of our model portfolios offered to our institutional clients here at Zacks Professional Services. And today we're going to be talking about a pretty interesting subject. It's going to be a quick call, but hopefully it'll be one that is informative and can and also help you find businesses that are of a high quality nature and caliber. So today's topic is investing in high quality businesses. And it's just a small little pro tip that I personally use when evaluating companies and their degree of quality. And so let's get started. Let's talk about exactly what I like to look for when picking stocks for the long haul. So this is an overall installment of an ongoing series that we've been talking about with regards to quality investing. A lot of people have a value focus or a growth focus, but not enough is addressed in terms of the quality factor, which can overlap either growth or value. Quality is a focus on earnings consistency. Let's talk about that a little bit here. So our overall strategy that we like to use, and this is borrowed, I want to give full credit to Fundsmith, which is one of my favorite investment managers out in the UK. And they have the saying, very, very simple. What's their strategy? To buy quality businesses, don't overpay. And after that, just do nothing. That's really it. And that is what has led to very, very solid results for them as well as for us, with the Zacks Earnings Certain Portfolio. So then that begs the question, which is what is quality, right? What is quality? And this is how we define quality. We define it as consistent earnings per share growth over time for a very long time. This also has to be accompanied by consistent cash flow growth. And these earnings and cash flow need to be at a high return on invested capital. So we like to look for businesses that consistently grow, but you also have to have capital allocation in mind. These companies should be generating attractive returns on invested capital for a very long time. So we don't like to find companies that are, generating growth at all costs. We want to find companies that are generating growth at an attractive ROIC. And those are the types of businesses that outperform the market in the long run. And this is made possible because these businesses are durable. They make products and services that are needed by people. And, as a result, they have, a high degree of recurring or reoccurring revenue. And they can do this because they have established economic, brand, or R&D moats. So let's take a look at exactly how to find companies that have that. So the key word here is consistency. We want consistent results, right? But, of course, that begs the question is how do we forecast the future with high conviction? How do we do this? So here's the pro tip. We want to look for businesses that have substantial recurring or reoccurring revenue. So the way to get that is to go to these companies' websites, their investor relations websites, and just scour through their investor presentations. This will give you, by just doing this alone, this will give you an edge over most investors and market participants because most people are not looking for these types of qualitative aspects because these items are not always databased by data providers. You can find companies very easily through, any number of screeners that have high revenue growth or have high earnings growth, but that's all after the fact. How do we forecast the future though? So let's take two examples to look at this. We have one American Tower and the other Roper Technologies. These are both holdings of our Earnings Certain Portfolio. So let's take these two as a case study and take a look at exactly how to forecast the future. So let's get started here. I'm going to go straight to their websites here. I have that open already. So let's start with, with Roper Technologies. Roper If you're unfamiliar with them, this is a roll-up, sort of an operating company, a holdings company. And Roper is run by, a terrific management team. And their entire business strategy is to buy small niche software businesses and roll them up into their overall holdings company. So they have a number of different brands, software companies that they own. And, they continuously buy them at attractive book value. They add value to them, by making them leaner. And they then generate, high returns on invested capital. And they do this over and over and over. So that's why their first slide on their investor deck, this is straight from their website. You can go over here to the Jeff, they just had a conference, hosted by Jefferies. You can just open up their investor presentation that they showed there. And, on their very first slide, we compound cash flow by acquiring and growing niche market-leading technology businesses. So they focus on niche markets, which can be a very, very lucrative, very, very profitable aspect of the market. Sometimes niche is the place to be to generate tremendous returns on capital, to be able to compound cash flow over time. Why? Because niche markets have very, very few competitors. That's what makes them niche. So they, find, software companies that are addressing niche needs and they buy them up. And that's exactly what their strategy has been for many, many years now. And you can see that these are some of the brands that they generate. These are very, very niche markets. Like, let's mention Aderant is a software, that is used by law firms, that, they can use that, to manage the docket. They can manage their calendars. It syncs with various different judicial calendars. So it's very, very useful for law firms. And there's very few competitors in that space. Seaboard is another example. This is a software that's used by cafeterias at universities and colleges. Again, very niche. These things serve, singular, purposes. But because of that, they have, dominant market position in that niche. That's exactly the type of business that they like to target. Niches that don't really have a whole lot of, competition. And because, they are very, very small, they don't attract the big dogs into them, right? Because they're very, very small. They often are, less than $1 billion in revenue, often, somewhere in the $100 million range. And so, they don't really attract, huge players like Google and, Salesforce and others like that, because these are very, very small for them to go after. But that's why they buy many of them, dozens of them, just like this, and roll them up into one operating company, a holdings company. And they add value in these different areas because that is their core competence, their expertise. So again, how do we know that this is, a recurring revenue model? You can see here that this is exactly their overall, approach. They focus on resilient organic growth. They focus on businesses that have high recurring revenue mix, strong margins, customer intimacy. So again, very, very strong customer, relationship management, very strong retention rates from customers. You can see exactly what they do here. So what they do is that they generate, cash flow from, these acquisitions, and then they simply reinvest all of that capital, redeploy that capital to acquire the next great business. And they keep doing that over and over again. And so this is the result, right? It started with just a few of these and it's grown into all of these companies here that they now own. These are all mostly software companies that all have, high recurring revenue. And they continuously do this to buy more and more and more of these types of market leading niche, businesses. This gives them very, very high confidence that they can generate substantial excess free cash flow and recurring free cash flow, which is the key point here to make. And because of that, that's generated significant outperformance. You can see that here. And this happens specifically because, they find these really, really small, relatively small companies that do, something very, very well in a very, very small niche market. And that's what makes them defensible in nature, because you don't have a ton of competition. So how do we know exactly, what level of, their revenue is recurring? Well, we can actually go to their Q2 financial results. And if I scroll down on this right here, they tell you that directly. And this is, if you just spend, 15 to 20 minutes, or maybe a half an hour to an hour, just going through these investor decks, right? This will give you a substantial leg up on most investors, most market participants, because most people are not doing this. You can see right here, they literally tell you this. It's in plain sight that, 61% of their revenue is recurring in nature, recurring or reoccurring. 54% is recurring, 7% reoccurring. So almost 2/3 of all of their revenue is recurring in nature. That is substantial. That's quality defined. You can basically see that right here. The quality of Roper's, portfolio meaningfully enhanced due to the fact that, almost 2/3 of all of their revenue is recurring in nature. That's exactly what we like to find in companies that are, high quality, recurring revenue. And then, you can see here that on top of that, 7% of that is organic revenue growth. So, in excess of recurring revenue, we also want to see organic revenue. So that's new revenue growth. That's coming from new acquisitions or from existing companies, but revenue growth from, their existing portfolio. So again, that's exactly what we want to see here from just a couple of minutes that you spend on their, company website. If you just look at their, investor deck, you can see that because this is, a substantially higher recurring revenue that provides a lot of cushion, during market turbulence. This is the main reason why we want to find companies that have high recurring revenue, is because that gives you added confidence, in case of a recession. And that's exactly what a lot of people are talking about right now. And that could be what's happening right now with bond yields inverted. The overall market may be headed to recession. We talked about this in our last strategy call. A lot of indicators, forward-looking indicators, are not yet calling a recession, but the bond market is, firmly calling a recession. Now that the bond market, in terms of the 10 to 2-year spread is firmly inverted, that's the bond market basically saying that, there is a recession coming in the next year or so. And so this is the time to start finding companies that are of high quality in nature, businesses that have very high, conviction in earnings growth. And the way to do that is to find companies that make needed products and services, and specifically companies that have high recurring revenue. Let's look at the next example here, American Tower. American Tower is another, this is a recent addition to the portfolio. We just added this one in Q2 of this year at the end of June 2022. This has been a phenomenal business as well. American Tower is actually a real estate investment trust, and they own, over 200,000 of these types of wireless towers here, American Tower Corporation. They own these properties all over the world. And, what these towers are basically used by tenants. And who are their tenants? They are basically your household names in wireless services. AT&T, T-Mobile, Verizon, and Sprint, and others as well. And so they build these towers. They, own the land, and they build the towers. So they own the land and the towers, and they then rent out, space on these towers for tenants to install their satellites, their, wireless radio, devices that is then used by their, subscribers, basically you and I, everyone that owns a cell phone. So these towers are, owned and operated by American Tower. And you can see that they are all over the world. They basically dominate the world, essentially, in owning these towers. Everyone that relies on cell phone service needs these towers. So you can see that a substantial number of them are in the U.S. and Canada, but a big presence in Brazil as well as India. In fact, India is the largest site that they own. Over 75,000 properties owned throughout India to serve their 1 billion plus, population. A big portion of which owns a mobile device. And so that is substantial. They basically dominate, the world essentially, in, these properties. So this is exactly how they do it, right? They, buy land, they build these towers, and then they rent these towers out. So this is their, economics here. If you have just one tenant, they generate just 3% return on investment, but they've gotten smarter and smarter over the years, is that if we simply rent out more tenants per tower, as you can see in this third diagram, the cost economics, gets very attractive. It goes from just 3% to 24%. So over the years, they've, gotten more and more sophisticated in building out these towers to be able to accommodate more and more tenants per tower. And so that's how they've, increased their return on invested capital over time. So for every dollar that they deploy in, building out these towers, they're generating more and more profit, per dollar that they invest. That's exactly how they generate, compound growth over time. So, how do we know exactly how much of that is recurring? There's another presentation. I just pulled it right off their website again. And this is exactly what tells you that, right? Kind of goes through what is a tower, what types of towers are there. And, these are the different types of towers that they build. The components that goes into these towers. It's actually really fascinating for, geeks out there. But I just love these types of businesses because, they do this in an area that is increasingly needed by everybody, right? As we, transition from, 4G to 5G, there is an everlasting need for wireless communications and wireless data. So they literally say this. Look at this. This is that key word right here. Recurring long-term revenue stream. That's exactly what we want, right? So they're basically saying this in plain sight. But most people, they can't see this because, they don't spend a whole lot of time researching, businesses. But you can see this chart right here. This is the money shot right here. They literally tell you that as of right now, as of 2021, they had $61 billion in non-cancellable lease revenue commitments. So this is not per year, but this is in total. And it's telling you exactly how that has grown over time. Exactly 10 years ago, they had just $20 billion in non-cancellable lease agreements. That has more than tripled now today going forward. So this is not yet recognized future revenue that they will recognize over time. 61 billion in non-cancelable lease revenue. So these are all commitments over a 5 to 10 year lease term that they sign their clients. So this is AT&T, T-Mobile, Verizon basically signing 5 to 10 year leases with American Tower, basically committing a total of $61 billion over that time frame. So, if you were to assume all of them are 10-year leases, then that's roughly $6 billion per year in revenue that is basically guaranteed. Okay. And that's basically, if you look at it right here, they generated $9.4 billion in total revenue in 2021. If we were to just do simple back of the envelope math, 61 billion over 10 years, that's 6 billion per year. They did 9.4 billion in 2021. That's again, almost 2/3, 6 divided by 9, almost 2/3 of all of their revenue is recurring in nature. And it's also non-cancelable because it's enforced by contract. So again, this is exactly what we love to find. Required companies that build things that are needed by the masses and have high recurring revenue. This will provide a substantial degree of confidence that their historical earnings growth will continue. You look at, Roper again, just looking at their price to earnings chart. This is, consistent revenue growth or, consistent earnings growth over time. And because 2/3 of that earnings growth is recurring in nature, we know that, the historical revenue growth is likely to continue, for the foreseeable future. Same thing if I were to switch over to AMT, we know that this earnings growth is likely to continue. Again, very, very stable growth right here. If I were to look at, and since AMT is actually organized as a REIT, their free cash flow is actually the better, metric for growth. And you can see how stable that growth is. Look at, how they performed in 2008, 2009. They're barely a budge. In fact, it looks like essentially there was no recession for them. And in fact, there wasn't. From 2008 to 2009, they grew their free cash flow through that period. And I believe that that's what's going to happen again, in case we do fall into a recession again. So this is exactly the type of businesses that we love to find, and deliver for you in the Earnings Certain Portfolio. But this is the pro tip. Find companies that, have substantial degree of recurring or reoccurring revenue. But the key is, they should be durable businesses with, established economic brand or R&D moats, right? They're delivering a product or service that's needed by people, by their customers. So that is all I had here for you today here. Hopefully you found this, useful and interesting. Again, if you have any questions, love to hear from you. If you're a ZRS client, please do reach out to us at zrs@zacks.com. Or if you are an Advisor Tools client, again, please reach out to us at zaat@zacks.com. All right, talk to you guys soon. Hope to see you for the next one. Take care.